Okay, so we're taking the example of an acquisition of an asset that's worth $50 million. $50 million asset purchase, of which $30 million will be raised in equity, $20 million in debt. And the terms of the debt, just to be simple, is 10% interest. What is the impact on the income statement, the cash flow statement, and the balance sheet? Right? So, for the first step, what do you guys think we should do? Income statement, cash flow statement, balance sheet impact.
Start with the raising of
So I would break this out transaction by transaction. Start with the raising of the stock or the raising of the debt. Fine, you chose raising of the stock. So how would you proceed with the raising of the stock?
Stock, you raised 30 million, so you cash of 30
We
million.
said 30 million in stock. In the financing activities of the cash flow statement, which would impact cash by 30 million. And then be consistent with the labeling here. So stock 30 million, cash 30 million. When you translate this into the balance sheet, cash in the cash flow statement drives cash. And stock will drive in the shareholders' equity section. We can call it stock or additional paid in capital. Let's keep it simple here, 30 million. And that balances. You also need to make an adjustment on the income statement to stock and maybe dividends. That's a side adjustment you would make in your model. Right? Okay. That's the equity. Equity's raised. We have cash of 30 million now. We need 20 more. We're going to raise debt to fund that. And how do we raise debt? Long-term debt on the cash flow statement, 20 million. Increases cash by 20 million. And the impact of the cash flow statement to the balance sheet is cash would increase cash by 20 million. And the long-term debt would increase the long-term debt and the liabilities of the balance sheet by 20 million. Cash up, debt up. Okay. But what else happens when you raise debt? There is over a period we'll assume that the interest would be incurred. We suggested 10% just as a quick assumption. And so what's the impact? We'll have interest expense, Colt, you mentioned. 2 million, right? We assumed 40% taxes, right? So taxes are going to be 0.8 million, right? So the net income impact is going to be 1.2 million down, right? Net income drives the cash flow statement. $1.2 million. And that flows right down to cash. So cash is going to go down a little bit based on the after-tax interest impact over a period, right? It's not an immediate reaction. And so cash affects cash, of course, 1.2 million. And net income drives what? Retained earnings, 1.2 million. So when raising debt, when raising equity is the blue. When raising debt, debt's raised, you receive cash. But then again, over a period, you'll assume interest is incurred, tax impact to that. And we spoke about the effects of earnings per share on each, right? Impact of earnings per share in raising debt is what?
Less dilutive than equity.
Because of what?
because of the risk involved in equity. So
What's the technical impact that's driving it?
Interest expense.
Tax affected interest expense. In this case, maybe some interest income because you have cash sitting on the balance sheet. We didn't use it yet. And then yes, exactly what Al said. And then the other impact is, of course, it's going to be dilutive to EPS, less dilutive than raising equity because of the associated risk associated with equity. You'd hope the investors have priced that in. So raising equity, the impact is what? Technical aspect.
change in share count.
Change in share count. And you'd hope that the investors have priced the stock such that the change in share count would make it more dilutive, which means they're receiving a greater return based on the risk.
Is that PE reciprocal? Is that like a rule of thumb, or is that something that people actually use?
Rule of thumb.
Okay.
There's some flaws to that. We'll see.
Right.
Rule of thumb. Okay. Now what? We've raised the cash, 30 million, 20 million, 50 million. We're going to now purchase the asset. So how do we go about purchasing the asset? CapEx in the investing activities. 50 million affects cash. 50 million. How does that drive the balance sheet? Cash, of course, impacts cash. 50 million. Spent that cash. And PP&E. PP&E up. We've bought an asset, converted cash into asset. CapEx, simple way to do it, maybe better purchase of asset. Separate line item if you want to separate a one-off large purchase from CapEx, which might be routine maintenance. But okay, but the flows are the same. So now what? We talked about what happens over a period, the implication of depreciation on that CapEx. And we said, let's say that CapEx depreciates on a straight line basis over 20 years. So now what? Depreciation? $2.5 million. So let's assume that there is D&A expense of $2.5 million. Tax deductible, $1 million, right? So the effective net income impact is $1.5 million, right? Net income, $1.5 million, drives the cash flow. Say again? Cash, $1.5 million. I'm sorry. Is that what you were saying, Colt?
Yes. So put it back in the mix.
Put it back in the mix.
Correct term.
Of course. D&A, $2.5 million. Right? Non-cash expense added back. So the cash impact is only the tax implication, $1 million. Okay, so now the net income, the depreciation, and the cash has to all affect the balance sheet in some way to keep the balance sheet in balance. How does it do that? Anybody? Cash up. 1 million.
Reduce public benefit.
Say it again.
Reduce PP&E by D&A.
PP&E is reduced by the depreciation incurred, 2.5 million. And what makes that balance? So we have an asset up 1, down 2.5, or down 1.5.
The negative retained.
Net income impacts retained earnings of 1.5 million. And then we finally said, what if we end up accelerating depreciation on that asset for deferred tax purposes? deferred tax liability is created. How do we calculate that deferred tax liability? What's the accelerated depreciation? We said let's use double declining balance. How do we figure out double declining balance?
It's double the depreciation that we used before.
So it would be 2 over the useful life, so 2 over 20 times the,
Yep.
Times the property.
Right. 2 over 20, or 1 over 20 times 2, 2 over 20, which is 10%. Double the depreciation, basically. Of the asset value is 50 million, so it's 5 million. The accelerated depreciation for the double declining balance is 1 over the straight line of 20 years, which is 1/20th, which is 5%. Double that, that's 10%. 10% of the value of the asset is 5 million. So the accelerated depreciation is 5 million minus the straight line of 2.5 gives us 2.5 million times tax rate of 40% gives it 1 million, right? 1 million is the deferred tax savings.
So you add that back to your cash flow statement.
So you add that back to the cash flow statement as deferred tax. 1 million increases cash by 1 million. And this affects the balance sheet, right? Deferred taxes becomes a liability. Deferred taxes, 1 million. And cash is 1 million. Right? So this does capture a lot of the major movements of the income statement, cash statement, balance sheet. It's a good thing to do to practice on your own, kind of make up numbers and try to draw it through it. And again, the interesting thing is, as we mentioned before, in order to do this in a model, and we'll do this for Walmart in a second, in order to do this in the model completely, to raise equity, what do? Cash flow statement. 1, to raise equity, cash flow statement, financing activities. This is hard coded, right? When this is hard coded, this flows into cash. This flows into your stock. You also have to make an adjustment to stock and dividends. That'll take care of all the blue, right? Equity's been raised. Cash will go up. For the debt, this is what we want to see affected. This comes from the debt schedule. If you go into the debt schedule and do a mandatory issuance of 20 million, that would flow into here, right? The issuances and retirement section of the financing activities. The debt schedule, when you raise debt, underneath each piece of debt, it calculates interest, which flows into the income statement. So when you make that adjustment in the debt schedule, that'll flow into long-term debt, increase your debt balance, increase your cash. That'll also flow into the interest expense and impact net income, etc. All the red. All the red's taken care of. The only thing we have to do now is go through the purchase of the asset, making sure that it impacts depreciation, making sure it also impacts accelerated depreciation for deferred tax purposes. And if your model is built properly with income statement, cash flow statement, balance sheet, along with a depreciation schedule that has both straight line and accelerated depreciation, all you need to do is by increasing CapEx in the cash flow statement, right, that will flow into your PP&E, that'll reduce your cash, that also flows into your depreciation schedule, into your straight line and accelerated. Straight line and accelerated the straight line will flow into the income statement and make the tax adjustments, and the accelerated will create your deferred taxes. So really, in a standard model, if built properly, it is built to handle a simple asset acquisition, and you only have to do 3 major steps. Increase the stock for the amount that you need to raise to fund the asset, increase the debt, that'll affect interest, and then increase the CapEx to impact the purchase. So for homework, if you're rusty on it, if you have it, or you can pass around, or however you're getting it, chapters, so part 2, chapter 3, we'll go over how to raise equity, how to raise debt, and then chapter 4 we'll go into how do you use this to buy an asset. So we'll do that, and then we'll talk about divesting an asset, and then we'll talk about, all right, well, I don't want to just acquire an asset, I want to acquire a whole entity, and we'll talk about how to go through that procedure, which is a lot more complex. But this is the seed. Any questions on that?